In February 2025, SanDisk began trading as an independent company at around $32 per share. Today, just 15 months later, it trades above $1,400. That is a gain of over 4,000%. In 2026 alone, the stock is up more than 550%, making it, by a massive margin, the best performing stock in the entire S&P 500 this year. This isn't a meme stock. This isn't a crypto gamble. This is a semiconductor company you probably knew as the brand on your USB drive. So what on earth happened? To understand SanDisk's story, you need to go back a bit. SanDisk was originally founded in 1988 and became one of the most recognized names in consumer flash storage, those little SD cards, USB drives, and memory sticks you've used for years. In 2016, Western Digital acquired the company for $19 billion, absorbing it into its larger storage empire. For nearly a decade, SanDisk disappeared as an independent brand, buried inside a conglomerate that also sold traditional hard disk drives. Then, activist investors, including Elliott Management, pushed for a change. The argument was simple. SanDisk's NAND flash business was being undervalued inside Western Digital. Investors couldn't see its true worth. The solution was a spin-off. On February 24, 2025, SanDisk completed a tax-free separation from Western Digital and relisted on the NASDAQ under its own ticker, SNDK. Western Digital shareholders received 1 share of SanDisk for every 3 shares of Western Digital they held. The stock opened around $32 to $34 per share. At that moment, very few people were paying attention. That was a mistake. On April 30, 2026, SanDisk reported its fiscal third quarter 2026 earnings, and the numbers were almost impossible to believe. Revenue, $5.95 billion. That's up 251% year over year and 97% quarter over quarter. In a single quarter, SanDisk nearly doubled its own revenue from the previous quarter. Non-GAAP gross margin, 78.4%. For context, a year earlier, that same margin was 22.5%. SanDisk went from a barely profitable commodity business to one of the highest margin semiconductor companies in the world in the span of 12 months. Earnings per share, $23.41. Analysts had expected somewhere around $14.50. SanDisk beat by over 60%. And the data center segment? Revenue of $1.47 billion, up 645% year over year. Not a typo, 645%. The company also announced it had eliminated all of its long-term debt, locked in over $42 billion in minimum contractual revenue through multi-year supply agreements, and authorized a $6 billion share buyback program. Bernstein raised its price target to $1,700 immediately after. Analysts at multiple firms described the results as unprecedented. The stock responded accordingly. Now, anyone who knows the memory chip industry knows its history. Massive booms followed by brutal collapses. So, is this just another cycle that will eventually unwind? The bull case argues this time is structurally different, and here's why. First, hyperscaler contracts. SanDisk has secured more than $11 billion in financial guarantees from customers under multi-year supply agreements. This is not spot market speculation. These are locked-in, long-term deals with major technology companies. Over a third of all bits sold in fiscal 2027 are already contracted. Second, the AI infrastructure build-out is still early. Spending on AI data center projects is projected to grow 15% from 2025 to 2026, and every AI cluster requires massive amounts of NAND storage. NVIDIA CEO Jensen Huang has specifically highlighted dedicated storage tiers as a key part of next-generation AI infrastructure, a direct tailwind for SanDisk's technology. Third, the pure play premium. Since its spin-off, SanDisk trades purely on its NAND business. There's no hard disk drag, no conglomerate discount. When NAND does well, SNDK does well. And right now, NAND is doing better than it ever has in history. Some analysts draw a parallel to NVIDIA in 2022, a company that transformed from a gaming chip maker into an AI infrastructure giant almost overnight. SanDisk, they argue, is undergoing a similar identity shift, from consumer storage brand to essential AI infrastructure company. But let's be honest about the risks, because they are real. First, the memory cycle. This industry has rewarded demand booms with capacity expansions that eventually produce brutal price collapses. It has happened repeatedly. Samsung and SK Hynix will not sit still forever. If prices stay this high, they will build more capacity, and that supply eventually comes to market. Second, early signs of cracks. SanDisk's own consumer segment already contracted 10% quarter-on-quarter in Q3. Not everything is immune. If AI spending slows or hyperscalers pull back, the cascade effect on NAND pricing could be fast and severe. Third, valuation. Even with these extraordinary earnings, the stock is trading at a premium. The average analyst price target implies roughly 20% downside from current levels. The stock has gone so far, so fast, that any negative surprise could trigger a violent correction. And fourth, concentration risk. SanDisk's surge in data center revenue is heavily tied to AI infrastructure spending. If a major AI player, think Microsoft, Google, or Amazon, signals a slowdown in CapEx, NAND stocks will feel it immediately. So where does that leave investors? If you got in at the spinoff at $32, congratulations. You are sitting on a 43 times return in 15 months. The question now is whether you hold or take profits. If you're looking at this today from the outside, the honest answer is the easy money has already been made. Entering above $1,400 means you are buying into a company that is already priced in an enormous amount of good news. The fundamentals are genuinely strong, but so is the risk of a pullback after a move this parabolic. The prudent approach, as most analysts suggest, if you want exposure, wait for a pullback of at least 10% before entering. Build the position gradually and think in terms of years, not weeks. The AI storage thesis is real. The cycle risk is also real. Both things can be true at the same time. The next major catalyst to watch, Q4 fiscal 2026 earnings, where investors will be looking to see if SanDisk can sustain those extraordinary margins, or if the first cracks start to show.